Hi everybody, this is Ellman with today's option selling question of the day. Today's question comes from Jorge. Hi Alan, when we are worried about the market, is it better to sell in the money calls or out of the money puts? Thanks, and it's signed Jorge. Well, option selection is the second of the three required skills to become elite option sellers. The first, stock selection. The second, option selection, which is what we're going to discuss in this Ask Alan video. And the third is position management, how to handle our trades once we enter them. Okay, so let's now talk about the moneyness of the options, and we'll go into focus in on both the in-the-money call and the out-of-the-money put. So for in-the-money calls, let's give an example. The stock is trading at 32, and we sell the in-the-money $30 strike. It's in the money or lower than current market value. Now, if we received a premium of $3 when we sold that 30 in-the-money call, of that $3, $2 is intrinsic value, the difference between current market value 32 and the strike 30. That is not profit, because we're going to lose that amount when the stock is sold. So we can't count the entire $3 as premium. We have to deduct the $2 from the 3, and that gives us $1 of initial time value profit. All right, now let's move on to the out of the money put. Same example. The stock is trading at 32. We're going to look at the $30 out of the money put, lower than current market value. So it's in the money for calls, but out of the money for puts. Now, if we received a premium of $1 when we sold that put, that would be all-time value. There's no intrinsic value to an out-of-the-money put. There's only intrinsic value for in-the-money strikes. So that gives us a foundation for the moneyness of the option as it relates to calls and puts. Let's now turn to a real-life example using ZTO Express Inc., ticker symbol ZTO, and it trades on the New York Stock Exchange. Now, on January 13th, 2020, ZTO was trading at 23.29. We're going to look at the 5-week expiration to February 21st, and we're going to look at the 22 in-the-money call, lower than current market value, and the 22 out-of-the-money put, below current market value. Now, the in-the-money call generated a premium of $1.55. And the out-of-the-money put generated a premium of 25 cents. The difference is that the call had an intrinsic value component to the premium, whereas the put did not. What we're going to do is we're going to evaluate the time value return on each one and the percent decline to the break even to see if one or the other gives us more benefit in a bear market environment. All right, let's for a moment have a look at the option chain for ZTO and show you where I got that information from. You could see on the top, we're looking at the calls, and the 22 in the money strike had a bid price of $1.55. And below that, you see the puts, and the out of the money 22 put had a bid price of 25 cents. So that's where I got that information, and that was taken from the cboe.com website. Now, let's start off with the calculations for the in-the-money call. And we're going to use the multiple tab of the Ellman calculator. As you can see here in the blue cells to the left, ZTO was trading at 23.29, and we sold the in-the-money 22 call for $1.55. The expiration date was 2/21/20. It's a 5-week return. Now, if we look over to the right side of the spreadsheet, we would see our ROE, or the return on our option. That's time value return. The calculator deducts the intrinsic value for us, is 1.2% for our 5-week return. Right? To annualize it, you would multiply it by about 10. So it's a little bit better than the 12% annualized return as far as time value of profit is concerned. Now, upside potential is zero because we're agreeing to sell our shares at a price lower than its current market value. So we can go to the moon. We're still only getting the call strike, which in this case was 22. However, take a look at that downside protection all the way to the far right, 5.5%. Now, what that means is that we are guaranteed a 1.2% 5-week return as long as share value does not decline by more than 5.5% by contract expiration. Now, what about to break even? Well, it's 6.7% to break even. And that makes sense. The 5.5 and the 1.2 adds up to 6.7. So to get down to our break-even point is 6.7. The initial time value return is 1.2. So try to keep those two statistics in mind as we turn now to the out-of-the-money put. And we're going to now feed that information into the BCI put calculator. Now, you could see on the top of the spreadsheet is where we put all the information. And you could see that the put premium was 25 cents. You recall that from the option chain. And then the information is calculated on the bottom. It becomes populated automatically. And you could see a return on our option, or ROE, of 1.15%. If you recall, that rounds out to 1.2. If you recall, in the multiple tab for the call, it was also 1.2. Now, percent discount if exercised, in other words, to break even, is 6.61%. It was 6.7 in the case of the call. So for all intent and purposes, they're pretty much the same. So there isn't that much of a difference in terms of the initial time value profit and the percent break to break even. Now, if we would have put a comparison chart out there just to compare the two in one page, you would see that the initial time value return 1.2 versus 1.15, and the percent to break even 6.7 to 6.61. So, pretty darn close. Now, the real advantage of put selling in a bear market environment is that if the price of the stock declines, but not below the put strike, we never really have to take possession of the stock, right? We could, over the weekend after expiration, we could make a determination regarding our bullish assumption on the security. Do we want to use that same underlying to sell another put the next contract month, or do we want to move on to a different security? So that would be the main advantage for put selling in a bear market environment. We may not have to take possession of that declining stock. Now, if I were to compare the two strategies in general, and this is taken from my book, Ellman Selling Cash Secured Puts, let's quickly go down the comparison chart here. Both strategies, covered call writing and selling cash secured puts, have a very similar risk-reward profile, exactly the same. So that's why a lot of people feel that there's absolutely no difference between the two strategies, when in fact there are some differences. Now, if you're a covered call writer, you own the shares, and therefore you do capture corporate dividends, whereas put sellers do not. Now, there is also a difference in the premiums when the ex-dividend date occurs before contract expiration, but I think it's important to just understand that covered call writers own the shares and therefore do capture the corporate dividends. Now, the maximum profit for covered call writing, if we sell an out-of-the-money call, in this case we didn't, we used in the money, but if we sell an out-of-the-money call, is that we can generate two income streams in the same contract month with the same trade, one from call premium and the other from share appreciation from current market value up to the out-of-the-money call strike. In the case of selling puts, the maximum profit is just the put premium, nothing else. Now, for covered call writing, we must buy the shares first. You know that. When we sell cash secured puts, we don't buy the stock, but we do have to put a certain amount of cash into our brokerage account to secure that put. And the amount is the put strike minus the put premium times 100 for each contract that we sell. Okay, so one case we buy the stock first, and in the case of the puts, we have to put a certain amount of cash into our brokerage account. Now, covered call writing I would use really in all market conditions, bearish to bullish. Put selling I like to favor in bearish to neutral market conditions for the reason I gave before, that we may never have to take possession of the stock if we're concerned about share price decline. Now, covered call writing universally across the board is allowed in our self-directed IRAs. Now, more and more brokers are allowing selling cash secured puts in a self-directed IRA, but not all. For covered call writing, it is all. Covered call writing requires a lower level of option trading approval from our brokers. Even though the strategies are so similar, brokerages feel that covered call writing is more intuitive to retail investors. The price of the stock goes up, so the price of the call option goes up. But in the case of puts, the price of the stock goes up, the value of the put goes down. So, there is a difference in terms of how the retail investor learns and understands the two strategies, and that's why there's a difference in the level of trading approval. Now, early assignment for covered call writing is no big deal. We know what we paid for the stock. We agreed to sell the shares at a price, certain price. So if it does happen, as long as there's no tax issues, who cares? As a matter of fact, it may be better for us because we get back the cash from selling the stock. It means we've maximized the trade, and perhaps we could use that cash to generate another income stream in the same month with that same cash. Now, in the case of put selling, early assignment may be a problem if we're unaware and the price of the stock is declining, and the next thing you know, we own the shares and we didn't have a chance to mitigate. So it's a rare situation, but it's possible. So that's just something that I wanted you to be aware of when you're comparing the two strategies. Now, before I go, I just want to remind all of you, our premium members, that only you have access to our entire library of now 179 Ask Alan videos. And we add a new video every single month. Just log on to the member site, scroll down on the left side to where it says Ask Alan. The first 10 are listed there. And then below that, just click on for more Ask Alan videos up to 179. Next month, we'll add another one. On the right side of the member page, you can, resources downloads area, go to Ask Alan video titles, and you'll get the title of all the Ask Alan videos there as well. So there you have it, ladies and gentlemen. Ask Alan number 179. Wow, I can't believe that we've done so many of these over the years. I want to thank Jorge for that terrific question that gives us an opportunity to enhance our strike selection skill set. So thank you very much, Jorge. And of course, thanks to everybody out there for taking the time to watch this video. I hope you enjoyed it. And most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.